This trading strategy using the MACD indicator is possibly one of the best that you will see because it has a high win rate, it's pretty easy to set up, and it works on almost all the markets. And most importantly, it makes you money. So without any further ado, let's get started. The MACD or moving average convergence divergence is one of the top technical indicators favored by traders. And this powerful tool utilizes the moving averages to pinpoint market trends. And trust me, it's incredibly effective at doing so. Now, if you've been trading for a while, chances are you've already encountered or used the MACD indicator. But let's be honest, on its own, the MACD is just decent. So stick around for the entire video to discover how I combine it with other indicators to significantly enhance its performance. First thing first, let's add the MACD indicator to the chart. For that, you can go to any charting platform or trading view, and inside here you can go towards the indicator tab, and here you want to search for MACD. And you want to add this moving average convergence divergence to the chart. Now that we have the MACD indicator added to the chart, let's make sure you understand how this works. The indicator consists of 4 components. First of all, we have the MACD line, then the signal line, then we have the histogram, and at last we have the zero line. The MACD line, which is blue in most cases, is a 12-period moving average. And the signal line, which is yellow in this case here, is a 26-period moving average. The histogram in the MACD indicator is the difference between the MACD line and the signal line. You can see that as the difference gets smaller and smaller, the histogram gets smaller as well. And whenever the difference gets bigger, the histogram gets bigger as well. The zero or baseline serves as the center of this histogram. Now that you understand the 4 components of the MACD indicator, let's make sure you understand how to use this indicator to its full potential. Now, how you can tell if the market is going to move in the upward or downward direction is by looking at the crossover and cross under between the MACD line and the signal line. For example, here you can see that the MACD line crosses above the signal line, indicating the upward trend in the market. And after this crossover, the market gave this bullish move. And conversely, whenever the MACD line crosses under the signal line, that represents the bearish momentum in the market, and the market moves in the bearish trend. You can also look at the histogram to determine the strength of the trend. For example, here you can see that the histogram bars are green and their colors are strong green, which represents that there is a huge momentum in the market in the upward direction. Whenever the colors of these green lines start fading out and the histogram becomes smaller and smaller, that means that the market is losing its bullish momentum. Now conversely, whenever there are strong red lines in the histogram in bearish direction, that means that there is a strong bearish trend in the market. And whenever the histogram becomes smaller and it's below this zero line, then that would mean that the market is losing its bearish trend or bearish momentum. Now, how you can use this indicator to take long and short positions is by looking at the crossovers and cross unders. For example, to take a long position, the MACD line should close above the signal line and it should be happening below this zero base line, because we only want to take long position when the market is possibly going to move in the bullish direction. For example, here you can see the crossover happening above the zero line, and in this case here we want to avoid this situation. And in this case here you can see that it is happening below this zero line, so we would take this long position at the close of this candle here where the crossover happens. And converse is true for taking short positions. The MACD line should cross below the signal line, and this represents the bearish momentum in the market. And you should also note that this cross under should be happening above this zero base line. So you can see the MACD indicator is pretty simple. Then why do traders lose money using this indicator? Well, most traders use this indicator on its own, and there is a huge downside to this strategy because this trader works pretty well in trending markets, as you can see here. But whenever the markets start moving inside a range, this indicator gives a lot of false signals because it's a lagging indicator. Now let me go ahead and share how you can avoid these false signals. To do that, we're going to go ahead towards the indicator tab, and here we're going to search for exponential moving average or EMA, and we're going to add this first one to the chart. Now this exponential moving average is going to filter out the ranging markets, and to do that we're going to go towards the indicator setting, and here inside the inputs we want to change the length from 9 to 200. This will make the period of this exponential moving average to 200, and in the style I'm going to go ahead and change its color to red and increase its thickness so that we can see it a little bit better. So now as you can see that this indicator will filter out the ranging markets. Now whenever the price is moving above this 200 period EMA, that would mean that the market is in bullish trend. And whenever the price is moving below this 200 period EMA, that would mean that the market is in bearish trend. Now to avoid those false signals, all we have to do is put the things together. Let me go ahead and share how you can take long positions using this strategy. First rule is that the market should be moving above this 200 period EMA line, indicating that the market is in bullish trend. The second rule is that there should be a crossover happening between this MACD line and the signal line, and MACD line should close above the signal line. And the third rule is that this crossover should be happening below the baseline of the MACD histogram. Once these three rules are met, we can go ahead and take a long position at the close of the candle where the crossover happens, and we can put our stop loss below the EMA line, and we can target 1.5 risk to our ratio. So as you can see here, in this case, this trade has been a profit of 1.5 risk to our ratio. Similarly, to take short positions, the first rule is that the price action should be happening below this 200 period EMA line, indicating that there is a downward trend in the market, and there should be a cross under happening between the MACD line and the signal line. As you can see here, the MACD line crosses below the signal line, so we can go ahead and take a short position at the close of this candle here, and we can put our stop loss above the 200 period EMA line, and again we can target 1.5 risk to our ratio. And another thing you should pay attention to is that this crossover should be happening above this zero line or baseline of the histogram, so that we want to make sure that the trend is only conversing from bullish to bearish. Now using this strategy, you can see that we are able to filter out a lot of false signals, and we are only taking profitable trades with high win ratio. I hope you liked this video. If you have any questions, please comment down below. I would love to answer them. Also, don't forget to like, share, and subscribe. See you guys in the next video. Thank you.